Hello, my name is Roy Thompson. I head up Carpenter Box Financial Advisors. With me today, I've got Henry Wilson, Investment Manager at LGT Wealth Management. I think it's really important in times like this, where there's a lot of rhetoric in the marketplace, certainly in the media, perhaps to have a conversation with someone who's dealing with, the purchase and sales of assets that might be made up within a portfolio, and to understand their line of thinking in the current market climate. So Henry, I think, absolutely we need to tackle head on announcements by the government here in the UK last week. The mini budget that was perhaps not such a mini budget. It's been everywhere you look over the course of the last few days. And we're now starting to hear talk of the Bank of England reacting to that with kind of emergency meetings. I don't know if you want to give us a little bit of your take on it from an investment management perspective.
Yeah, I mean, from our side, it was most unconservative like the budget. It was a far cry from Thatcher and Lawson days of quite conservative management of the budget, and there is a certain amount of scepticism or a lack of confidence now in UK institutions, not just the government but also now the Bank of England. And to kind of stop this fall in gilts, that's UK government bonds, and the sterling, as we've seen, sterling has fallen a lot, nearly reaching parity actually on Monday morning. To stop that fall, we need a credible plan from not just Truss and Kwarteng in terms of how they're going to tackle this fiscal deficit and get the debt burden down. At a time when interest rates are, at a decade high or so, but also we need a credible plan from the Bank of England, and we need them to step forward and say, probably more than just say or verbalize it, but also come out with quite a strong statement and action of raising rates, probably at an ad hoc meeting. So that would provide a bit of an underpinning to the market and make people, I think, a bit more comfortable with the plans. But spending £150 billion over the next 2 years on the energy price cap, and then also doing unfunded tax cuts is quite a dangerous recipe for disaster.
So I think, if I listen to people react to it, there's been a lot of negative press, a lot of people suggesting that the government are gambling on futures, and sort of easy to understand why. Certainly some of the tax cuts that have been suggested or put out there to be deployed over the course of the next perhaps 9 months or so, whilst they have a benefit to a good number of people, basic rate taxpayers, business owners, all the way through to people who pay the top rate of tax, they do lean towards those wealthier individuals. I guess, I look at that and hear clients say to me, well, try to understand the logic of why they've done it. So just in very quick summary, what would be the logic behind the suggestions that have been made in terms of these tax cuts? What are the government trying to do with that?
So there is there's a kind of line of economic theory, and looking back at the data, some of it quite kind of backs this up quite well, that a lower tax burden economy, one that is less regulated and where the government plays a smaller role, can enable business to flourish. It can attract inward investment from overseas. It can attract overseas investors to bring over a lot of investment, build things, employ staff, and create a quick, dynamic, fast-paced economy that is kind of stimulates growth. And so by having a lower tax burden, they might encourage business owners, people working in financial services, Europeans, Americans, Asians to come over, set up shop here, to move their family here, and to pay their taxes here. And if you're a multinational corporation, perhaps instead of having various different offices around the world or booking profits in various different locations, if the UK is actually giving you a favourable tax rate on your corporation tax and on your top rate of tax, then actually you might decide to just book all of your profits centrally in the UK. And that would, of course, over time lead to further tax increases for the government, because if you're a multinational that had only 10% of your profits being booked in the UK and 100% of it's now, well, yes, the actual rate that's being taken out is lower. You've got a much greater proportion of the
bigger slice of the pie. So that would sound, if we believe that, and if the government was successful with that, that would be a positive for the UK. But what you might be saying is the timing of that is, with increasing interest rates, inflation out of control, and just publicly with people perhaps struggling with finances on a day-to-day basis, the timing of that might be quite poor.
Yes, so economically there is a fair amount of kind of evidence that supports their ideas, but politically it seems a kind of a poison chalice. I don't, at the moment, as you say, with the cost of living crisis on our hands and homelessness and poverty set to rise, to be doing kind of politically naive things like removing the banker bonus cap and things like that just strikes as being incredibly naive, particularly given that the Tory party have always been associated with the party for the wealthy or whatever. So politically perhaps a bit naive, but one can kind of see what they were trying to achieve. And we shouldn't forget really that actually one of the big things they're doing, the big costly thing is the £150 billion energy price cap, which should allow more money to be spent in the local economy. If your energy bills are lower than they were going to be beforehand, that means that there's more money to spend down at the pub or at the local football club or your rugby club. That should help the economy remain relatively robust. And if we do see a recession, it'll be much less severe than it would have been if they hadn't come out and done that energy price cap.
Okay. So market's unsettled by this largely because it's quite drastic. It's a big change, and very unsure about how that's going to pan out. One of the things that's happened is we've seen very much a strengthening dollar versus the pound. So it feels like on the basis we're a country that imports more than we export. A weak pound doesn't help the inflation story. You as an investment house have been you favoured the US economy. How are things going in the US? Because I guess, that's been less in the news over the course of the last few weeks.
Yeah, absolutely. So we've had an overweight position towards the US. It's our biggest investment region or geography. And it's the home of, by far and away, the highest quality companies, those companies that are able to grow into big global businesses. You just don't find another country that is able to develop those types of fast-growing, exciting businesses. So we continue to allocate capital there, and we really have been beneficiaries of a strong dollar this year. So all else being equal, that when we convert back those earnings, the dollars into sterling, we've done very well this year. But recognizing that until we convert them and currency hedge them, we haven't actually locked in that gain. So over the coming days, we're likely to start to apply hedges to just a small proportion of the portfolio, so that if we do see a reversal of the sterling weakness and it starts to recover, that we don't give up a lot of those paper-based gains that we've made. It would be a huge amount of hedging. We're mindful of over-hedging. We're mindful of the fact that it would increase costs. But from a tactical risk mitigation perspective, it makes sense for us to be active and on the front foot and lock in some of those gains.
So the underlying economy in the US, though, of course, they've suffered with inflation as well, which has proved to be stubborn. The Federal Reserve, the equivalent of the Bank of England, has raised rates. Their view has still been quite stern. When I read, they're looking at further rate increase. Do you see an end to that? Are we nearing the point where you think that might be the top end of what the market's looking like over there?
Yeah, so if we're at kind of 3.25 or so today, it looks like the market estimates that it'll be anywhere between kind of 4.5 and 5 is where the end interest rate settles at. If that is the case, then we might find that the next 2 or 3 Federal Reserve meetings will be enough for them to hit that rate. And so we're very much further along the way than we were at the start of the year. We've had many rate rises, 3 percentage points worth of rate rises so far, versus an anticipated 25 or 50 basis points. If you took kind of October or November last year for the estimate for 2022. So a lot of the pain has now been borne, and it's now just a matter of sitting calm and seeing what the next couple of rate rises say and Federal Reserve meetings say. And it also in turn looking at the data. Is the inflation data showing that it's materially coming off? is when we really drill down into the data, is core inflation data showing signs of coming off, all of those kinds of things, before we can really say with confidence that we're through this rate rising cycle.
So, and then I guess moving on from there, I think of China or the Far East. They've had very strict policy on COVID, and that remains. There's some fairly extreme rhetoric coming out around foreigners coming into the country and don't even physically touch them. So it seems quite dramatic. Where are we with kind of the Far East, China, in terms of their economy? It's been stop-start with their zero tolerance approach to COVID. Do we see that continuing?
Yeah, it's a great question. It's very hard to create economic growth while you're having to shut down whole regions and cities at a time. And there's been a little bit of a whisper along the way that it's been a little bit political, trying to shut down regions that are kind of pro-government or anti-government and things like that. Well, more anti-government, but look, the main thing is we are fundamental investors. So we look at the underlying data and we try and understand what's going on. Is the data strong? Is it weak? And when we look at the data, we're seeing that valuations are very, very cheap, 8 or 9 times for the Chinese index. Some companies are trading at less than book value. That means that you could sell all of the different component parts of the company and you'd get more for the company than is listed on the stock market today. Yeah. And when we speak to our fund managers, they say that it's unprecedentedly cheap. So in many ways, you've had a situation where they've suffered year to date. Chinese equities have suffered year to date. And yet they're now priced for zero growth. So it's almost a free option on the upside. If we do see growth, then they will do well. But the markets become so negative that the valuations are very depressed. And we think there's a good chance that the government will continue to come out with stimulus, with fiscal measures to try and stimulate the economy. They really do believe in this 5.5% growth rate. It's unlikely to hit it, but as they keep on stimulating, it should help to prop up the economy, and it should help risk assets. Because have you seen what happened to risk assets like equities in the West against the backdrop of raising rates and tightening monetary policy? They're loosening monetary policy in China. So that should help do the opposite as what's happened in the West this year, where risk assets have really suffered.
I guess that's a good point. If you think of risk assets, people would think of the stock market. Many a person sort of listening into this might say, well, I've lost a lot of money this year, and it brings into question about what actions they should take. Our view, Carpenter Box, would be that, look, if you've got money to cover your short and medium term expenditure, so let's say that's out for 3, 4, 5 years, then if you've got excess money over that, retirement funds or longer term money, then you should remain invested, or you should be an investor. Do you still think, as an investment manager, that that's a sensible approach to be taking?
Definitely. More often than not, equity markets go up, and they go up comfortably above inflation over the very long term. And so if you want to beat inflation over the long run, then equities is definitely the home to be, in my humble opinion. And there's always some reason to be negative or bearish. If you look back over the last 10 or 20 years, just the last kind of 5 or so years, you've had COVID, Trump, Brexit, China-US trade war, Ebola, Russia-Ukraine invasion, and then just a bit before that, the Greek bailout, the Eurozone solidarity and breakup concerns. These things happen. That is part of the parcel of investing, and that's why some assets, like risk assets, while if you can time your entry relatively well, they provide a very attractive upside. That's what you get paid for taking that risk, essentially. But our forward-looking returns are now pointing quite attractive. So, for example, we can get 4% or so on a collection of high-quality US government bonds, and we can get upwards of 8% on some good quality US high-yield bonds. So, a blended return of 5-6% on our bonds is quite attractive. We get 1.7% on our cash fund. And the forward-looking returns for equities, if you take something like the formula, which is known as the earnings yield, which is next year's earnings per share over the share price today, that's pointing at a forward real return of around 6 or 7%. So, these are looking like some quite attractive levels of return going forward, but you need to be able to bear through the period of volatility. And one thing that we've seen recently is that institutional cash levels have started growing a lot. We haven't seen cash levels like this since 9/11 actually. And that's usually quite a good contrarian indicator, because it means that people are ready to start putting money back into the market. One thing that often scares us is when people are over-invested and you get that kind of the mania, too much money chasing too few assets. We have the opposite right now. So, again, we might be close to the end of that kind of uncomfortable cycle and nearer to a new cycle than we were at the start of the year.
You might be, for people invested, then you might be urging patience, and for people considering, there's still plenty of people out there considering investment. As long as they're looking at that as a long-term solution, then there is some value to be had out there in terms of investment markets.
Definitely, I think two people that I often kind of refer back to in these moments. His first one was Warren Buffett. He said the stock market is a mechanism of transferring money from the impatient to the patient. So, no better investor to listen to than Warren Buffett. So keep patient. But also, Jack Bogle, the founder of Vanguard, he was once asked what to do in a bear market, and he said there is no one size fits all answer to a bear market, because they're all different. But what I will say is that one of the worst things that you can do in a bear market is to stop your regular premiums in and withdraw your money. The whole essence of investing is to buy low and sell high. So, in the bear market, keep your regular premiums in, allow the pound cost averaging to have that impact of buying more units when the price is low and selling more units when the price is high.
Yeah, I think that's right. But I think people get, very rightly so, very concerned with, what might happen in the short term, because, from what you said, going right the way back to the UK market, things could get a little bit uglier yet. The US, we've still got maybe a little bit of pain to go, and the Far East might be prime for, future growth, but the timing of that's going to be very difficult to predict. So, short term, there can be some pain, but in the longer term, it still offers good value.
Definitely. And what the nub of what we're trying to do, the essence of what we're trying to do here is identify fantastic quality businesses whose earnings are resolute, whose business model is strong, whose management teams are experienced, and who are able to navigate these periods of disruption. And if we think something like a Microsoft, if we can own a fantastic, wonderful company like Microsoft, interest rates will not be the determiner of Microsoft's returns over the next 5 or 10 years or 20. It's going to be, can they continue to make great capital allocation decisions and have a product is at the forefront of everything we do in the business setting? And if they can, then it doesn't really matter what happens to interest rates, because in the short term, yes, the market is a weighing machine, or a voting machine rather, but in the long run, it is a weighing machine, and the market will start to appreciate how resolute Microsoft earnings are, how fantastic its profits are, how it's able to pass on higher input costs to its end customer. It has pricing power. That's the number of what we're trying to do. And so, yes, things will go up and they'll go down, and there'll be lots of noise day to day, but the number of what we're doing is identifying high quality businesses that should be here not just for 1 or 2 years, but 10 and 15 years time.
I think that's a really useful reminder, when we see what's going on and read the papers or look at your app, and, it's all fairly bleak news. At the end of the day, it's a common market, and, what we need to do is we need to consider the good quality decisions that will benefit us over the longer run. So, Henry, I really appreciate you taking the time to go through that today, and thank you very much for the update.
Thank you. Good to speak. Cheers. Bye.
Cheers, Henry.